Welcome back to the channel, everyone. Something has been dominating my feed lately. AI bubbles, market crash, tech collapse. And this isn't some secret coordination, it's what always happens. A major media narrative breaks, creators chase the same framing for clicks, and the algorithm reinforces a single story until it feels universal. But repetition isn't analysis. Think about what's really being suggested here. People are selling ownership stakes in the most productive technology infrastructure in history in exchange for dollars. At the exact moment the global economy is showing signs of needing lower interest rates and potentially renewed liquidity injections. That's a trade I'm definitely not interested in making. So let's cut through the noise. Today we're looking at the two serious arguments that AI bears are making. Circular financing, that Nvidia and the hyperscalers are creating fake demand by funding customers who then buy their own products. And secondly, the GPU depreciation argument. The AI profits are being inflated by spreading hardware costs over unrealistic lifespans. We're going to examine both claims clinically and see if they actually hold up. So the first claim goes like this. Nvidia or cloud giants invest billions in AI companies. Those companies then use the capital to purchase GPUs or cloud services from the same firm, which creates a financial loop. Money goes out as an investment and comes back as reported revenues. Critics argue that this inflates growth, creates artificial demand, keeps stocks price elevated. If that were driving the majority of this demand, it would be a big problem, wouldn't it? But here's what actually matters. This behavior is not illegal. These are real transactions, real services are delivered, and revenue recognition complies with accounting rules. The issue isn't legality, it's whether these deals meaningfully drive industry growth. Honest answer is no, not at scale. Circular or vendor finance deals represent a small slice of total demand. The dominant buyers of Nvidia hardware are Microsoft, Google, Meta, and Amazon. These companies are deploying hundreds of billions of dollars of their own operating cash flow into AI infrastructure because it's strategically essential to their business. Circular ecosystem investment exists, but they accelerate adoption. They do not power the revenue engine. And of course, for Nvidia, this isn't reckless hype. It's platform strategy. Participating in ecosystem financing pulls GPU demand forward, locks customers into the CUDA software stack early, creates massive switching costs before the competition can penetrate the markets, and builds platform dominance while the industry matures. Nvidia isn't just selling chips here, it's trying to cement its leadership in this infrastructure race. This behavior exists in every early infrastructure cycle. We saw it in the telecoms build-out, the renewable energy expansion, EV manufacturing, early cloud infrastructure. In early waves, capital always races ahead of profitability. Circular deals aren't proof of a bubble, they're symptoms of market formation. The second pillar that I want to address is GPU depreciation. The claim is that GPUs are replaced every 2 to 3 years as new generations come out, but hyperscalers depreciate that hardware over 4 to 6 years, which spreads the cost out slowly and inflates current earnings. The flaw in this argument is assuming GPUs have a linear lifecycle, which of course they don't. They follow a cascade lifecycle. New GPUs are used for frontier training, first-gen old GPUs, larger scale inference, and old GPUs for batch inference and enterprise deployment. These chips don't just vanish, they move down the stack. Older GPUs do maintain high utilization, particularly for inference workloads that don't require the bleeding edge technology. The key thing here is that economic usefulness lasts for longer than technological leadership. Because GPUs generate revenues across multiple workload tiers, I believe a 4 to 6 year depreciation model is defensible. It's not perfect, of course, but I don't think these companies are being fraudulent or reckless with this accounting. Let's zoom out for a second because this is where a lot of people get this wrong. Even critics have been careful to frame Nvidia as Cisco, not Enron, and that distinction really matters. Enron was about fabricated numbers, hidden debt, fake revenues, and outright fraud. Whereas Cisco was a real company riding a genuine infrastructure boom, but its stock collapsed when the market massively overestimated how quickly that infrastructure would be monetized. So when people say Nvidia is the next Cisco, what they mean is the business is real, the demand is real, but markets may be paying too much for growth that eventually normalizes. Now let's compare the two eras. In the dot-com cycle, spending came from unprofitable telecom firms and speculative startups, using heavy debt to build up fiber networks, routers, and data capacity. This was years before actual demand existed at scale. Today, the AI build-out is funded by the most profitable companies in history, Microsoft, Google, Apple, and Meta. spending hundreds of billions of dollars of real cash flow into infrastructure that directly defends their existing moats. This doesn't mean there's no overshoot risk. Capital cycles always tend to overshoot. We may get periods where GPU supply catches up faster than revenue growth, or data center capacity is temporarily underutilized. But that's very different from saying this is fake or this is Enron 2.0. What we're watching is a classic capital intensive infrastructure cycle. Real assets, real revenues, cash flow backed spending, with the usual market risks that growth gets priced too aggressively too early. So what's the actual bubble? It's not AI compute. The real bubble risk doesn't sit at the foundation of the stack, it forms on top of it. Because this is how every capital cycle works. Profits concentrate at the bottleneck, but speculation overprices the layers above them. So the most vulnerable areas right now are venture-backed AI startups priced on fantasy margins that assume they'll never face competition, public stocks trading on platform monopolies, where in reality they don't control platforms or distribution, they just consume compute, and thin wrapper businesses whose apparent margins exist only because compute is temporarily subsidized. Those margins evaporate once pricing normalizes. Meanwhile, the infrastructure builders, Nvidia and other chip manufacturers, the hyperscalers clouds, the owners of global AI platforms and distribution sit in the true power positions, don't they? They benefit whether models proliferate, prices compress, or new application layers get competed down. Because no matter who wins at the app layer, they all still have to rent the same bottlenecks. This isn't the end of an AI hype cycle. It's the beginning of a multi-year capital cycle, one where returns will be extremely uneven. Valuation bubbles will burst in pockets, but the infra winners will be quietly compounded. Most people approach bubbles emotionally. Is this real hype? A better framing is, where does profit structurally survive when hype fades? And the answer is almost always at the bottlenecks, not the stories built on top of them. So yeah, parts of this market will absolutely deflate, but that doesn't mean the opportunity is gone. It means the opportunity is where most people are looking. I've done a number of deep dives on companies I think are positioned on the right side of the cycle across chips, compute platforms, and select beneficiaries. So if you haven't seen those yet, feel free to check them out after this video. Thank you so much for watching the video. Please understand this is not investment advice, this is just my opinion. And please feel free to like, comment, and subscribe. Thank you so much.